Hi students, I am Esther Thamarine, Head Department of Commerce, Section 3. Today we are going to discuss on income from house property. This is a very important topic, and before knowing what is income from house property, first let us have one example. Mr. A have invested in so many assets. He have one residential house, he have one flats, he have invested in land, he have other sources of property. He gets a regular rent from all these incomes. Here, to understand what is the house property income, we have to know what are the basis of charge. Here I gave you an example of Mr. A, the property he holds. All the property cannot be a house property. The basis of charges according to Section 22 of Income Tax Act have certain conditions, three major conditions to say the house property. First one is the property must be a building or land apparent to. It should be a building. So all the land cannot be, all the property cannot be a house property income. It should be a building. And not only building, anything attached with it or near, apparent to means nearer to. So along with the building, the assets or the place attached with the building is also a income from house property. The second thing is the assessee must be a owner. Let me go back to the example. He have a land or he have a property which was taken as a lease from another person. That building was given sublet to another person. So from the subletting, he gets some income. This income cannot be a house property income because he is not the owner of the house property. So the second condition says that the assessee must be the owner of the property. Then thirdly, the condition says that it should not be used for any business or profession. So the house property income is should satisfy these three conditions. The first one, it should be a building and anything attached with the building. Then secondly, it should be the assessee should be the owner of the property, and the third one is he should not have a business or profession in that building. To determine the house property income, we need to know what is the annual rental value. Annual rental value is nothing but the sum which the property might reasonably be expected during a period of time, that is in 1 year time. The amount which we expect as a rent from a particular property, you call it as for 1 year, you call it as a annual rental value. In order to know what is the annual rental value, we need 4 factors to be considered. The first one is municipal value, second one is fair rental value, third one is standard rent, and fourth one is actual rent received. The municipal rental value, it is nothing but the value assessed by the local authority for assessing the tax, municipal tax. So the local authority might be the municipality which assess value for our property. So based on that, the tax will be collected. The second one is fair rental value. The fair rental value is the value of the similar property in that same locality with the same facilities. So this value will be considered for calculating the annual rental value. Then the third one is standard rent. The standard rent is nothing but it is through the Rent Control Act, they fix some value to our property. You call it as a standard rent. Then the last one is actual rent. So though we have the 3 different ways of valuing our property, we collect rent from the tenant a different amount. That you call it as a actual rent received. In order to calculate the annual rental value, we need all the 4 factors: municipal rental value, fair rental value, standard rent, actual rent received. Let us move on to the calculation of gross annual value. Gross annual value, for that we need to compare municipal rental value fair rental value, whichever higher will be taken, and that will be compared with the standard rent, and whichever less will be taken, that you call it as a expected rental value. This expected rental value will be compared with the actual rent received, whichever higher will be taken as a gross annual value. Before going for the comparison, you have to give deduction for the loss due to vacancy. Then you can go for the gross annual value. This one is income from house property for let out house. Let out houses, we have to calculate the gross annual value less the municipal tax only if it is paid by the owner. So after deduction you get net annual value. This net annual value is eligible for deduction under section 24. The section 24 consists of standard deduction, which is 30% of NAV, and also we have a deduction eligible, that is interest on borrowed capital. This borrowed capital is for constructing the house. So the income from house property will be assessed. Next one is the income from the house property for the self-occupied house. Self-occupied houses, the assessee can have one house for his residential purpose, and that you call it as a self-occupied. Even if you have more than one house will be, which is having the gross annual value maximum, will be considered as a self-occupied house. For the self-occupied house, the gross annual value will be nil. The net annual value will also be nil. But this self-occupied house have the eligibility to get deduction under section 24 only for the interest on loan for the house property. So always the self-occupied house will have a loss from the house property. There are certain important points we have to make it clear before we work out the problems. The self-occupied house, the gross annual value will be nil, and only the interest part you can claim it for deduction, and always the self-occupied house have a loss from the house property. So let us have one problem. This is computation of gross annual value. Here we have four factors, that is actual rent, fair rental, municipal rental value and standard rent, and here we have unrealized rent for 2 months. So how to calculate the gross annual value? So as per the thing, you compare the municipal rental value and the fair rental value, whichever will be higher, then that will be compared with the standard rent, whichever is less, and actual rent received will be taken, and along with that unrealized rent. Unrealized rent is the tenant not paid the rent. Okay, so that will be considered, and here in this problem actual rent fixed is 96,000, but unrealized rent is 16,000. So the rent received by the assessee is only 80,000. So this will be compared with the ERV, and whichever higher will be taken as annual rent. Then next problem, here it is also similar, but here the house is vacant for 2 months. So how to handle this situation? It is similar to the previous problem. Whichever higher will be taken, and then it is compared with the actual rent, and then we can calculate the annual rental value less the loss on vacancy. The house is remained vacant for 2 months. This can be deducted with the annual rental value, and gross annual value is 60,000. The next problem, it is also similar. There we have certain expenses, repairs, ground rent, insurance premium. See here, this expenses cannot be allowable as deduction, because we can see the solution. Here in this problem there are certain expenses given like repairs, ground rent, insurance premium. See how to treat this expenses. The standard deduction 30% is allowed as a deduction. So these expenses not considered, only 30% flat in deduction is given, and so we can calculate the income from house property. Then the next problem, we have this municipal tax paid by the assessee 10% and 2% municipal tax on sanitation expenses is considered. Okay, how to calculate the net annual value? The net annual value will be calculated by deducting the municipal taxes and sanitation charges. This expenses is allowed only when the assessee paid these expenses. Okay, so the gross annual value should be deducted with municipal tax and sanitation charges. That will be the net annual value. Here we have another example. Here municipal tax paid 10%, then also along with that there is a watchman's salary, gardener's salary. These expenses are considered. Okay, here these expenses need to be considered for calculating the net annual value. So municipal value 7,50,000 and the rent received, rent for, he have 40 flats, each flat cost rent received is 1,500 for 12 months, it is 7,20,000. So he can claim for the expenses like lift maintenance, water pump expenses, gardener's salary, watchman's salary. Okay, so all these put together we have 20,000 as expenses. This 20,000 is deducted from the rent received, 7 lakh. So we can compare the municipal value and the actual rent received, whichever higher will be the gross annual value. So to the gross annual value, we can deduct the municipal tax paid, 10% is paid. So gross annual value minus the municipal tax will get the net annual value. To this net annual value, we are eligible for a deduction under section 24. The standard deduction is 30% on the net annual value, that is 6,75,000. So 2,02,500 is the amount. Along with that, we have interest on loan for construction. So this amount is also eligible for deduction. So along with that, standard deduction and interest, we can claim the deduction and the outcome is income from a house property. So the self-occupied house, the gross annual value is nil, but for the let out house, we can claim under standard deduction 30% of NAV and interest for the construction of the house. These two expenses we can claim as a deduction. Deducting this net annual value with the standard deduction, we get the income from house property. This income from house property is one of the head of gross total income. So this amount will be considered for taxable income of an assessee. Thank you.